So we are starting this seminar today, the webinar today. I would like to, of course, greet everyone. Good afternoon and good morning to everyone who has joined us for this dialogue today from India and abroad. On behalf of the India Initiative on Climate Risks and Sustainable Finance, which is anchored by Climate Bonds Initiative with its partners ODI and Optus ESG, I welcome our esteemed speakers from the Ministry of Finance, Government of India, the British High Commission in India, leading public and private sector banks and policy experts who will weigh in on the state of preparedness and efforts required and those underway already within the financial sector on navigating the imminent transition in the backdrop of global summits, namely the G20 under the Indian presidency and the COP28. Before we open the discussion today, some house rules and information. We are live streaming this session and the recorded video will be on YouTube channels of Climate Bonds and ODI. Please share your questions in the Q&A box and we will take it up at the end of our panel discussion. Now, I would like to take the opportunity to set the context a little further before inviting Ms. Geetu Joshi, who is the Economic Advisor, Ministry of Finance, for her opening remarks. And she led the Sustainable Finance Working Group for G20 Indian Presidency. I will then hand it over to my colleague, Sarojit Iyer from Optus ESG, who will moderate the discussion. You will then hear the closing remarks from Sarah Taylor, Minister Counselor, British High Commission in India. And then we will come to a close of the discussion. To open the conversation, I think it's good to get an idea of a few high-level trends and developments, which will increasingly inform domestic and international dialogues, negotiations, and action on sustainable finance. So when I was looking at today's discussion, I thought that there are 5 big trends that one should keep in mind, against the backdrop of which our further discussion will happen today. One is that there is an onward march of regulation and policy for financing sustainable transition, globally and in India. That this is irreversible is a fact. Directing finance at scale will determine the pace of transition. And planning ahead its different dimensions will determine how orderly this transition will be. Both these aspects are important. The pace and the orderliness of sustainable or green transition, and I'm using green in a broad sense of the term. The second trend is that there is a twofold focus. There is definitely a focus from the regulation side on risk management by financial institutions. Credible transition plans are coming into vogue. Institutional investors are asking for that, and banking institutions and regulators are also beginning to talk about a credible and a systematic transition plan, which can help readjust their portfolios towards sustainability and low-risk investments. It is also backed by a system of disclosures. As we speak, there are different disclosure frameworks which have come about, in fact, in the last year, including international disclosure frameworks like IISB. And then there are national domestic jurisdictional disclosures. Where would it lead to in terms of more interoperability, feasibility of their usability, is something that I think every jurisdiction is taking into account. Then there is a second focus, which is a sharpened focus on mobilizing finance for climate action by attracting resources, involving multilateral development banks, and encouraging a lot of private investment in green and low carbon technologies. The third trend is actually about going beyond renewable energy alone. Now, every year, a whopping $20 trillion gets invested in hard-to-abate sectors. Hard-to-abate sectors are like steel, cement, chemical, etc., which are major contributors to emissions. But only a fraction of it, a mere 250 billion, is actually directed towards the transition efforts that are required to be taken for lowering emissions in these hard-to-abate sectors. The fourth big trend is that just transition has become an imperative. This is now the consensus. Just transition not only safeguards sustainable development, but it is also important because without it, transition will be inherently fragile. For a developing country like India, it is even more important to equally give attention to not only the decarbonization efforts, but to the efforts on resilience, on job creation, on affordability of goods and services, so that no one is actually adversely affected as a result of this green transition. And the fifth thing, which I always say, is that everyone is learning together. Regulators are putting systems in place. Real economy actors are looking at making changes in their production processes. Financial institutions are beginning to grapple with a whole lot of new requirements, which are actually forward-looking. In that sense, they are different from what they have been doing till now in terms of ESG. So all of this has the characteristic of simultaneity of developments, trends, requirements, and that makes the job a little bit harder than we would expect it to be. So everybody is learning together, everybody is doing together, doing a lot of things together. When it comes to these are trends which are universal. They are happening globally and they're also happening within countries. I would just now touch upon a couple of important feedback points that we keep on getting from the market when it comes to the Indian ecosystem, Indian financial ecosystem, and as well as the companies which are trying to make shifts in their investments, in their capital expenditure towards sustainable and climate responsive projects. One is that they all think that we need a cohesive and overarching sustainable finance roadmap for India. And efforts in this direction had been taken by the Ministry of Finance in the pre-G20 year. And hopefully they will pick up again as we now have more attention that we can give to the domestic efforts which are already underway. The second requirement and the need that is always articulated is prioritization of capacity enhancement, because varying levels of awareness and capacity within the banking sector regarding ESG, sustainability, and climate-related issues exists, and their understanding of the materiality of those aspects for their operations is also at different stages of maturity. The third thing that we keep on hearing is about building data comparability. Quality and quantity of data reported. There are persistent challenges with regard to that in terms of quality, in terms of harmonization, in terms of assurance systems, particularly in the context of ESG and climate considerations. The fourth thing that we hear, roundtable after roundtable, conference after conference, is to prioritize a system of classification of definitions, what we otherwise call taxonomy. This is important for regulatory clarity to distinguish among different types of sustainable and transition initiatives. The fifth thing, which I think there is now work happening as we speak in India, it is about delineating and putting out transition pathways, sector transition pathways, and enabling policies to de-risk investments as we move toward net zero target for India across economy in different sectors. So when I look at our discussion today, a couple of questions come to my mind. What are the practical measures that are required for accelerated action to shift lending to low carbon activities? What is the role of financial sector and what are individual financial entities doing in this regard? And what opportunities lie ahead for transition finance, financial entities for their own resource mobilization through capital markets? Of course, there are many interrelated questions that we will delve into when we get into the panel discussion. But before we do that, I will invite now Ms. Geetu Joshi, Economic Advisor, Ministry of Finance, who led the Sustainable Finance Working Group for G20, to give her opening remarks on how to align and accelerate ambition, given that two major summits, global summits, also have domestic implications. So over to you, Ms. Joshi. Thank you so much.
Thank you, Neha. A very good morning and good evening to all. And thank you for giving me an opportunity to interact with you all today. It is my pleasure to discuss a critical component of our nation's financial evolution, the integration of sustainable finance into the core of our economic systems. We stand at a juncture where India's financial sector is increasingly recognizing the necessity of addressing low carbon transition risks. Further, we are meeting at a time when the global economy is confronted with multiple challenges, such as rising interest rates, unprecedented levels of debt, high inflation, and geopolitical tension. Addressing these challenges necessitates collaborative efforts along with innovative and inclusive solutions which propel sustainable development. Platforms such as the G20 and COP play a pivotal role in facilitating dialogues and arriving at collective solutions by bringing together all the stakeholders. Recently concluded, India's G20 presidency and COP28 addressed a multitude of globally significant issues. To begin with, I would like to highlight a few key outcomes of India's G20 presidency. India steered what can be called a global south imperative when it comes to sustainable finance. The Green Development Pact provides pathways for countries in their journey towards achieving the energy, climate, environment, and disaster resilience related objectives. G20 leaders also called for bigger, better, and more effective multilateral development banks, which will enable increased finance for climate and other global public goods. The G20 Sustainable Finance Working Group developed recommendations for mobilizing climate finance by scaling up blended finance instruments and risk sharing facilities, acknowledging that developing economies will need affordable and easily accessible finance in much greater volumes and at much greater speed. Many of these proposals were also echoed at the COP28, including the need to have new collective quantified goals, which must be guided by the needs and requirements of the developing countries. While significant strides have been achieved, there is still much work ahead of us. Building upon the outcomes of India's G20 presidency on mechanisms to mobilize finance for climate action, the Brazilian G20 presidency has taken up optimizing access to international environment and climate funds such as the GCF, the Global Environment Facility, Climate Investment Funds, and the Adaptation Fund as one of the key priority areas. In addition, the Brazilian presidency will also focus on the challenges and the benefits of sustainability reporting standards, particularly for SMEs and the EMDEs. For India's financial sector to thrive in this new landscape resulting from several recent developments, there are two critical areas of focus. The first is fostering a robust regulatory environment where financial institutions are not only compliant but also proactive in their approach towards sustainable finance. The second is enhancing the capabilities within our financial institutions to comprehend and integrate climate risks into their decision making processes. This necessitates a blend of technical assistance and capacity building, underscored by a culture of continuous learning and adaptation. Now, coming to the first area, that is robust regulatory environment, my colleagues from the banking industry would agree that in the past few years, RBI and SEBI have come up with several regulations and frameworks which will help in aligning the financial flows with the sustainability objectives. Some of these initiatives include Sovereign Green Bonds Framework, Social Stock Exchange, regulatory guidelines for thematic green bonds, regulatory framework for issuance of green debt securities, the BRSR framework for sustainability disclosures, and RBI's regulatory guidelines on climate risk and sustainable finance. I'm sure as we go forward, we will see many more developments in the regulatory framework in the future. Coming to the second area on the capacity building aspect, which is the topic of discussion today, I would like to spend the next few minutes on the G20 Sustainable Finance Technical Assistance Action Plan, which in short I'll refer to as TAP, and which was developed during our presidency to cater to the unique sustainable finance needs of developing countries. The TAP was endorsed by the G20 leaders and is strategically positioned to address the capacity building and technical assistance requirements of financial market participants. As a global platform convened by the UNDP, TAP promises to be a nexus of knowledge and resources. It aims to synchronize efforts among core financial stakeholders such as the MDBs, public development banks, think tanks, private sector entities, and capacity building providers. This collaboration will enable a tailored approach to capacity building, ensuring that technical assistance is both relevant and effective. The TAP's role in this transition is multifaceted. It is set to provide a framework for peer learning, facilitate interoperability with global best practices, and offers targeted technical assistance on areas such as risk analysis, transition planning, etc. This initiative will empower bankers and other financial sector experts in India with the necessary skills to navigate green and resilient investments. More so, it will provide access to critical information and services to facilitate these investments, thereby aligning our financial sector with the global trajectory towards sustainability. As we embark on this path to a low carbon economy, it's imperative to understand that our financial sector is a key player in this transformation. The TAP, with its comprehensive approach to capacity building and technical assistance, will be instrumental in this journey. It offers an opportunity for our financial institutions to not only mitigate the risks associated with climate change, but also to harness the immense opportunities it presents for sustainable development. Given the urgent need of capacity building to address transition risks, the India Initiative on Climate Risks and Sustainable Finance by Climate Bonds and other partners is a welcome intervention which could align its operations with the ambitions of G20 leaders as reflected in the Technical Assistance Action Plan. In closing, I would like to emphasize the significance of this moment. The transition to sustainable finance is not just an environmental imperative, but also an economic opportunity. With the right framework, guidance, and collaborative efforts under initiatives like the TAP, India's financial sector is well positioned to lead this transition, contributing significantly to global efforts in combating climate change and promoting sustainable development. Thank you for your attention, and I look forward to our collective progress in this crucial endeavor. Thank you so much.
Thank you, Geeta. Thank you so much. That's comprehensive and almost a call to action for the ecosystem players, including market participants, regulators, policymakers. So definitely what you're saying would mean that there is more collaboration, that there is more cooperation amongst different stakeholders, and there is more listening and conversation across regulatory policy space and market participants. And with that, I think it is time to hear from the practitioners themselves of what they are doing and what requires to be done in a much more concrete and systematic manner. So over to you, Saurajit.
Thank you, Neha. And yes, indeed, a very important call for action from Ms. Joshi in her keynote address. Thank you, ma'am. Very warm welcome to all the panelists and participants once again. My name is Saurajit Iyer. I'm Vice President at Octus ESG. It's a global advisory services firm that is engaged in sustainable finance and climate strategy projects for financial institutions across emerging economies. Now, the UK is partnering for Accelerated Climate Transition Program, or the UK Pact program, which, along with the India Initiative on Sustainable Finance and Climate Risks, led by the Consortium of Climate Bonds, Octus ESG, and ODI, are hosting this particular virtual webinar today. So the UK Pact program is a flagship program generously funded by the UK government to enable low carbon transition in emerging economies, and really aims to strengthen the understanding and adoption integration of climate risks within the Indian banking sector as part of the India program specifically. So we'll be talking on this particular panel discussion on focusing on building capacities towards managing climate risks and opportunities more effectively within the Indian banking space, what is required, and what really the bankers are doing and facing, and what they really need going forward. Now, as part of the broader program under this UK Pact India project, the consortium of these two institutions was awarded a second round of funding, in fact, in 2023-24, building on the success of the first round of funding back in 21. So this particular program now really includes two main work streams: design and delivery of 2-day skill enhancement modules individually for large Indian banks to identify, measure, manage climate risks and transition planning. And so far, these sessions have been conducted with as much as 11 large Indian banks, covering as many as 450 officers from across risk, credit, banking, and product teams. And this round also involves drafting research-based knowledge reports on, quantifying the financial risks associated with transition in the power sector, with climate-related investment needs in certain sectors, with the aim to support the supervisor, the RBI, in introducing climate responsive guidelines and disclosure. And of course, all of this is being supported by the curation of bilateral meetings, thought leadership articles, and virtual seminars like today's session. So coming to today's session, once again, thanks again to our keynote speaker, Ms. Geetu Joshi. And I would now like to extend a warm welcome to our panelist speakers, Ms. JC Paul. She's the Chief General Manager, ESG and Climate Finance, State Bank of India. Welcome, ma'am. Mr. Manish Kumar, he's the ESG at Manish Kumar, he's the head of ESG at ICICI Bank. Welcome, sir. Mr. Ajit Kumar, he's the head of market risk and ESG at Federal Bank. Welcome, Ajit. We should also be joined soon with Professor Ulrich. Ulrich has joined. Welcome, Ulrich. He's the professor of economics at and the director of the Center for Sustainable Finance at SOAS at the University of London. Now, this particular panel discussion will really focus on the climate risks and opportunities facing the financial sector in a very large, high growth emerging market like India, with a particular emphasis on the ways and means to build capacity within the banks to identify, measure, manage, and mitigate climate-related financial risks and transition planning. That's really the broader objective. But at the same time, before moving into the questions with the panelists, very quickly to set a bit of context and build on what our previous speakers have already said, India is facing a very tricky situation. If you actually look at the data, India's emissions are now today 3 times higher than the pre-economic reforms period, while GDP is 10 times higher. Now, at a cursory glance, that actually indicates that the GHG to GDP intensity has actually come down. Today, it is about 1:1. But the fact remains, it is still very, very high for comfort. And especially considering that the country is on a very high, economic growth trajectory in the coming years. So bringing down this intensity to the G20 average of 0.4 to 1 would really require moving the country's real economy to more sustainable business model strategies, decoupling the emissions-based economic model, and the role of banks to finance that entire transition. And that is really what makes today's topic such a critical one. The good news is that India is proving capable. We've seen that in the renewable sector. We've seen that in some other spaces as well. But that being said, and a lot of work has happened as part of the G20 and the COP and all the conversations that India has been having there. I'll not go into the details, but essentially we are on the track, but at the same time, a lot more needs to be done. Now, we have a very relevant set of stakeholders here as part of this panel discussion. both from the practitioner side and also from the academia research side. I would request each panelist to please restrict their response to 5 minutes per answer so that we stay within the time. And I will also request members of the audience to put any questions they may have in the chat box in advance, and we will try to take them towards the end of this session on a first come first serve basis. So moving to the panel discussion now, let me start with you, Professor Ulrich, more for an outside-in perspective. So given the amount of research work you've been doing in this space, you have seen a lot of different countries, perspectives from different countries, including some in Asia, that have very, very similar socioeconomic profiles to India. How they are approaching that entire process to model and measure climate risk in their respective sectors. So given this entire perspective that you've gained, in your view, what would you really suggest to Indian financial institutions and banks on what would be the most ideal or best method or approach they should be using to manage climate risk? Over to you, Professor Wilder.
Yeah, thank you so much, and thanks a lot for having me. Great to be with you. Well, I don't think there's like just one simple thing to do. I mean, it's really a broad set of measures. First of all, very clearly, each and every financial institution needs to build up capacity to understand the fundamental challenges and start kind of at a higher level to analyze what are potentially material risks. What are the different exposures in the balance sheet, so to also think strategically about the approach to lending, to investment, and so on. And so, of course, what there needs to happen is to systematically integrate climate risk analysis into the broader risk management frameworks. And here now, climate stress testing has become a focal point. And of course, the Reserve Bank of India has been working very intensively on that. And here I think it's important that on the one hand, we have individual financial institutions starting to develop their own ideas and think about how to identify risks and vulnerabilities. But we do need the central bank, the supervisors, to provide some firm guidance on how to go about it. Yeah, and I mean, this is exactly what the Reserve Bank is doing right now. But as I said, to effectively run stress tests, for example, you need to build up expertise. You need to have staff that really learn about the details, and of course we're talking about both physical and transition risk that matter. And so I think having a process where, on the one hand, the supervisors demand from institutions to kind of ramp up their own capacities, to think about their own strategies, is one important element. But at the same time, we do need also some firm guidance from the central regulator.
Great. Thank you, point taken. Let me now go to Ms. J.C. Paul, because for an inside-out view from our practitioners, because at the end of the day, India has its own nuances and a lot of challenges, particular to the Indian market as well. It's a large economy. So what has been some of your experiences on the challenges that Indian banks are currently facing to take on this task, Ms. Paul, especially given that all these broader NDCs, net zero goals are giving some direction to the journey ahead. So how are you navigating these challenges at your bank? And how could the international community support Indian banks towards this context? Over to you, Ms. Paul.
Good afternoon, everyone, and thank you. I'm grateful to the organizers for this opportunity to speak on this very relevant webinar. So coming to your question, Saurajit, yes, India is committed to an NDC 2070, and we are awaiting the roadmap pathways, which are the sectors, government policies with regard to how we are going to, as a country, we are going to reach that net zero by 2070, which sectors to focus, etc. So when we talk about net zero, we are actually looking at what is it that really contributed to the climate changes, and how do we really address the reasons what contributed to the climate changes, and how do we really bring down the carbon emissions or GHG emissions? How do we reduce the carbon emissions and reach that net zero path? That is one side of one aspect of climate change. And when we talk about climate risk, we are talking about the other side of climate change. That is, what are the risks that is caused to enterprises, businesses as a consequence of climate change. So these are two related aspects, but different aspects which need different solutions. So as rightly pointed out by earlier speakers, in the Indian banking system, as we all of us know, we started taking climate change, climate risk seriously maybe in the recent past. So the largest challenge, according to me, will be capacity building. Banks as of now, Indian banks as of now, in my view, do not have the capabilities, expertise, domain expertise, skill sets, etc., to address this problem. Either side, the net zero side, that is reducing carbon emission. Of course, banks on their own, their operations, carbon emission may be insignificant. But what is significant is the financed emissions, the emissions from their finance portfolio. So to address that problem on one side, the other side is what is the climate risk posed by the finance portfolio risk, whether it is physical risk or transition risk. We haven't reached a stage, we have the capabilities to measure that, how to go about it. So biggest challenge, according to me, capacity building. So within SBI, we have taken certain initiatives. One is that we have put in a dedicated team to take care of all the areas associated with climate, ESG, climate change, climate risk, climate finance, etc. But again, this team also, it's not that this team having put in place a focused team, that is only a beginning. So we need to ensure that this team gains the required capabilities over a period of time. So for that, in that direction, what we are doing is that we have been collaborating with entities in the field, climate experts, financial experts, modeling experts in the field. Like, okay, you would remember you also had taken a session for our people, some 10-hour session. So we are collaborating with many entities in the field for knowledge sharing, updating people on what is happening in the space, what is the requirement, how to go about, etc. That is one thing. Second thing, as part of capacity building, we have also done, we are making certain courses mandatory for every official in the bank. It's a very basic level course which creates awareness. Okay. Targeted trainings wherein, like, we have a very structured training system, training institutions, wherein every official has to undergo certain trainings every year related to his field. So what we are mandated now is that any training for more than 3 days period should necessarily have a session on ESG and climate change and climate risk, etc. Sure. That is another thing we have done. And we have made certain courses like sustainability and climate risk, etc., which can be done by the employees on their own. So that is internal capacity building. So we have started this way. Again, okay, to build up the team, we are also looking at recruiting from the market, domain experts, climate scientists from the market. We actually did one round of interviews, etc., for this. But the experience is that talent pool in the market also very difficult to get. So I think India as a country, maybe we have to look at the entire ecosystem has to develop. And now that this regulatory compulsions, policy compulsions, those are in place on the banks and the ecosystem, I think the ecosystem will be developing. As somebody pointed out, all of us are at different maturities of learning. So I think going forward, the ecosystem should develop. We should have uh, professionals with competencies who should be able to help out the banks in building capacity. So that is one major challenge. Second challenge will be whether it is net zero or climate risk. Second challenge will be availability of relevant data. Relevant data, integrity of data, availability, timely availability of data. I look at it as a major challenge because uh, see, most of the corporates, I think they wouldn't have identified the risk drivers affecting their specific activities or sectors. Neither would they have put in place mechanism to collect data relevant for them to assess climate risk. So that will be another major challenge, availability of data. Then for Indian banks, again, challenges will be what are the tools to be deployed? What are the models that will be most suitable for the banks to assess their climate risk? So these are the major challenges I see. So all these bring me back to my first point, capacity building, which will take time. So we are counting or collaborating with entities which are active in this field to help us measure, say, finance emissions, decide climate risk, physical risk, or transition risk, which will be a base for us to design our strategies to move forward. In the space of, say, transition, in the space of net zero, once we have our finance emission numbers sector-wise, we would know where we are and where to focus to move forward. But again, we have to align ourselves with the government policies which we are awaiting. That is India's roadmap to net zero to 2070. And on the other side, okay, once we measure our physical risk, transition risk, etc., we would know actually where to focus, how to engage with the clients, and again, the opportunity that presents to us, the transition finance. What are the capex requirements for corporates or companies to make for a transition to a lower carbon processes or technology shifts in technologies deployed, etc.? That gives an opportunity also for us. So once we have these numbers in place, we are working on it. Once these are in place, we will be in a better position to design our strategies, of course, with external help at the time being. Thank you.
Thank you. Thank you, Ms. Paul. In fact, going back to a point you raised at the initial, so the way I'm reading it is that it's two parts. So one is translating the net zero or the NDC goals into what it really means for business. So if we have to reduce emissions from X to Y, what does it translate for the business and hence the bank? That is one part of the entire capacity piece. The other piece is that once we know what we have to do, okay, we have to reduce it from X to Y, then what does it mean for our internal processes, systems and processes? What are the changes we need to do? Manish, Ms. Paul mentioned ecosystems, capacity, data as some of the major challenges. I'll come to you. I'll pose the same question to you, that from your perspective, what are some of the challenges that you think banks are facing in this entire process to manage climate risk?
Yeah. Thanks, Shurajit, and thanks to the organizers for having me on the panel. I'll take a step back. Of course, whatever JC mentioned are relevant. I'll just take a step back. I think everything starts from the tone from the top. So, while we might work in the right direction to build capacities, to really create awareness, is it really translating into the right tone at the top? And is it really action oriented? I think the focus now has to shift more towards action, what Neha also alluded to. And, in fact, I will refer to a report which was put out by the RBI itself. It was a report on currency and finance. I think it was published in May 2023. And there RBI has specifically noted that despite awareness that potential impact of climate risks on financial health of entities, so everybody is aware that there is a potential impact, mitigation plans are only getting discussed. It's all only in the discussion phase. Now, this has to now translate into an action. Again, RBI has indicated time and again, please use proxy data. And this is not only by the RBI, even regulators worldwide. They are saying, why don't you start using proxy data? Why don't you start using a proportionate approach? Why should we really wait for the regulators to take the first step? Because ultimately we are all actors in this entire journey. We will also have to partake any of the risks that could potentially impact our businesses themselves. So I think one important aspect now is that tone from the top has to start looking at action. The second part, is the reporting framework. Again, what Neha mentioned about. Now, there has to evolve a standardized reporting framework. And the reason I'm saying is that is where the data becomes important. So while, we might be searching for data, or while, some corporates or entities may have data available, how do they really present the data is also very important. So that whatever information is being right now put out by the companies, I feel there is a misalignment of the disclosure versus the decision usefulness of that information. Now that bridge has to gap. So that is the big challenge which I would say Indian banks are facing to really assess the climate risks, which can potentially impact portfolio. And then we are talking about finance emissions. So I would like to put the challenge this way.
Absolutely. I take your point. In fact, you raised two fantastic points. I'll take the second one before that, ultimately, or rather the first one, sorry. Ultimately, it's the push from the top. So in fact, I'll come back to you because I'm also, and I'm sure all our other panelists and participants are also curious to know what will it take to get that push from the top? So what will it take to get the push so that we start looking at identifying proxy data points and set the ball rolling instead of just waiting for regulations to happen? Because regulators are also learning, and I mean, this is a new topic for everybody. So I will be very interested to come back to you on that point, but let me first go to Ajit. We've kept you waiting for quite some time. Sorry for that. But Ajit, you are leading ESG climate at a mid-sized Indian bank. And the reason I mentioned that specifically is because a lot of mid-sized banks in the Indian ecosystem are actually proving more agile and adaptable when it comes to all these emerging issues, integrating these emerging issues. So your bank has also undertaken some initiatives, I understand. Could you just share, how you went about this process at your institution, how you navigated some of the issues, challenges, headwinds that, you faced in the process? Over to you.
Yeah, am I audible? Yeah, so first of all, thank you, Saurajit and Aurea, for giving me this opportunity to take part as a panelist in this esteemed webinar. So in this regard, I first of all fully endorse the views of Manish, because we are doing a lot of things even before this, a lot of things in a lot of manner. But when we look at a climate point or climate perspective, things have to get the shape. So the starting point is a strong endorsement from the top and the board. So that is where we started with in this journey. And climate risk actually forms part of our enterprise risk appetite. And this helped in climate-related discussions or climate risk discussions within the C-suite. And the support from the board was tremendous in all these regards. We also mapped our credit portfolio to different climate vulnerabilities based on geographies and sectoral energy dependencies. Basically, geographies in the physical sector, physical risk, and based on sectoral energy dependencies in the transitions. And this data is used to assess potential credit risk through sensitivity analysis, and the outcome is included in our ICAP and stress testing process. We formulated a dedicated ESG and E&S division, which has representatives from across the verticals. We also have an E&S committee, which is headed by our MD and CEO, and which looks into the climate-related risk and ESG-related matters. And this committee meets at least once in a quarter regularly and takes stock of what are things are happening in the climate-related areas or the risk-related areas, ESG-related areas in our bank. Parallelly, we have also put in place a board-approved ESMS policy where all the credit proposals are reviewed against the E&S or environmental and social impacts that the projects can create. And as per the ESMS policy, we need to do ES due diligence, E&S due diligence, and also risk categorize it into high, medium, and low, and do the ESDD. For that, actually, we are following the IFC's performance standards. And in this regard, actually, capacity building is again an important thing. We have even recruited people from the market for who are specifically doing this E&S due diligence in other organizations. Now they are a part of us. All these things will be helping. And based on this ESDD, we need to again give them ESAPs which will again help in mitigating the climate-related or environment and social-related risk, which is created by those portfolios. And our strategic relationship IFC has also helped a lot in this regard in institutionalizing the ESMS process, including the capacity building program. The most tough call taken by the bank was on the decision to phase out our entire call exposure by 2030, even when we know that there are business opportunities beyond the state, far beyond the state. And we have to say no to otherwise highly creditworthy names. But the board and the management was convinced that in our journey to become the most admired bank, these calls need to be taken in the best interest of the higher society or the larger society and the planet. We also have some exclusion list activities wherein we cannot fund. Some of those are like the critically polluting sectors like the oil and gas exploration, again aligning to the beginning of the end of fossil fuel era. So in short, by implementing all these, we are trying to make our credit portfolio future ready and would be able to stay ahead of the curve. And again, I am endorsing Mr. Manish. Actually, the tone and the tone at the top and the awareness are the key to the success of climate journey in any bank as of now.
In that case, Ajit, let me put you in a tricky spot right now for 1 minute at least and ask you that question, which I was curious from Manish's answer as well. And in fact, in certain things, Mr. Paul also alluded to that. You started your answer saying that the board and this is what it did, this is what it did, etc. The question really is, what made them do it? What was the trigger that you made your board give that instruction or guidance from the top? So 1 minute to you, Ajit, if you want to add some.
Yeah, to be clear, actually, before the onset of COVID, I think in 2019, we presented a presentation to the board on ESG and climate related risk, wherein actually that time we are getting the news, like we know about the Global Economic Forum. Even yesterday, last week, the last day also, they have released the global risk reports. And even if you see the next 10 years, if you see the first 4 is again on climate, and in the first 10, 5 are related to climate. And by 2015, most of the cities won't be there, like they would be submerged under the water. So that was the beginning of all these things, wherein we have presented this thing to the board and the senior management. And from there only we have been thinking about that. Then the onset of COVID was there, then things were muted, but COVID has again prompted many things. And we have also from our own experience, the flood that happened in 2018, that was a once in 100-year flood, which happened in our own Kerala. We know what all things happen. And now these things are getting repeated, and every now and then whenever a monsoon is coming, we are afraid what will happen next. So these are the triggers which might have prompted.
So Manish and JC, we got some clues from Federal Bank's experience and what were the triggers for the push from the top. It's a journey in any case, and I mean, whether it is the India initiative, the UK PAC program, all of us are there to help the practitioners in this particular journey. Let me come back to, we heard in the previous round all the Indian banking practitioners speaking about certain challenges that they are facing in the process. Data seems to be quite an important gap that banks are facing that is limiting or inhibiting them from implementing practical action. So this is your studies globally. How do you find large banks, across the world, especially in emerging markets, addressing this gap around climate data, climate information? Over to you.
Yeah, thank you. I mean, data is indeed a critical issue, and it's a challenge everywhere. So, and so we've been having these discussions about, we don't have the right data, the right granularity, and so on, also in advanced economies. But as one colleague mentioned before, one has to start somewhere. So even if one does not have the perfect data, one has to start working with proxies and so on, and there are ways to work around, and it really is a process. So we need to think, okay, what are the data that we would like to use, and then how can we get there? And there's certainly a very important role also for regulators, supervisors in working with the industry on how to make the relevant data available. And so there's one important issue, of course, around disclosures. I mean, there often is a bit of a reluctance, kind of banks feel bad having to ask all kinds of additional information from their clients. But in turn, real economy firms also, they need to do transition risk analysis. They need to do transition planning as well. So they themselves, as part of prudent management, will have to work on generating data that the financial sector needs. So it's really the whole ecosystem, and so there it's very important that we have from governments and financial supervisors really guidance on what kind of data should be generated. And here I think so this is kind of the mandatory issue of mandatory disclosures. There's now, specifically with regard to transition risk, globally a very intensive discussions about transition plans. So, for example, in the UK and Europe, we are very advanced now in requiring large corporations to do transition plans, and also supervisors are now realizing that these transition plans actually are really important also for prudential purposes, because they contain information that financial institutions and the supervisors themselves can use for micro and macro prudential risk analysis. So having some firm guidance is important. And I would just like to emphasize also that there is a huge potential for using digital approaches to try to automate data generation as much as possible. So we need huge amounts of data, but that's, kind of even beyond climate. And the financial sector is changing. We are moving more and more digital anyway. So when you think of relevant data points for analyzing transition risk, so for example, energy consumption, emissions, and all that, we can use data, for example, from energy companies. The problem is, of course, that right now this information is not publicly available, but so we can have governments, supervisors work together with energy providers kind of to create data pools, make these data pools available to financial institutions who can then in an automated way analyze real-time data on energy use and so on, which can really facilitate a lot of the discussion. So because it's really important that we, of course, don't make things too costly.
So I think Sorajit has a connectivity problem, and maybe he's just dropped out. Oliver, I would like you to just get in touch with Sorajit and to bring him back in. But if I could just come in at this point in time, when it comes to all the things that we have been discussing till now in terms of challenges, what we heard, repeatedly now, I think RBI is also making it clear, and it's actually engaging with a lot of banks. So with a lot of banks to understand what their data constraints are and where they are at in the journey. I would like to go back to Uli for a while in saying that, yes, we need guidance, and there are approaches adopted by central banks all over the world to have macro level systemic stress tests, and to actually look at what the banks are able to do right now and go bottom up. In which sort of a combination do you think emerging economies are looking at this question of scenario and stress testing and integrating a lot of things? There seems to be too much to do. So where is the sort of a balance that you're finding in emerging economies when it comes to looking at data and this kind of stress test models that the banks should be adopting?
Yeah, very good point. I think obviously every country needs to find its own balance, but I think what you don't want to see is just having, some centralized stress testing by the central bank, by the regulator, because you do want to have ownership. You do want banking institutions to really, do analysis themselves to understand what it's actually about, and because ultimately the banks, it's their responsibility to manage the risk, to mitigate the risk. So you don't want to just delegate it all to the central bank, but at the same time, it's really important that you do have some comparability. Yeah. So we do need the central bank, the supervisor, to provide firm guidance on what is expected from financial institutions. It's certainly important that the central bank, the supervisor, provides the scenarios with which the financial institutions then work, because you need, again, comparability of the results, and the scenarios are a central piece, and that's of course also something where the RBI is working on now. It's really critical to develop scenarios that really fit the local context. Yeah, so we have seen the development of all kinds of scenarios at the global level by the NGFS, so this network of central banks and financial supervisors, and they're very useful and helpful, but they don't really capture the specifics of the Indian context, and so it is important to really have these local scenarios that both the RBI and the banks can work with, and again. I think actually, ideally, there would be some kind of, a parallel structure where you have both bottom up and top down. Yeah, because at the end of the day, the central bank also needs to conduct stress testing analysis from a macroprudential perspective. Yeah, so taking a systemic perspective, and this you can't delegate to the banks. So you do need the central bank to really conduct this macro stress testing. But of course, they can also feed the analysis from conducted by the banks into this, and at the same time also kind of check if this analysis has been conducted in a sober way.
So thanks, Ali. I think that really, while my colleague Sarojit is just simply fallen off the radar, I will just, pitch in for him. Just what you said. Let me just put the same question to State Bank of India.
Sorry to
Uh,
interrupt. Hi, Neha.
um,
This is Deepika.
yes, that's all right. If you could just mute yourself, I'm in touch with Sarojit. So if you could
Yeah,
just mute yourself, that's all right. Yes. So Ms. JC, my question to you is that as India's largest bank, and taking from what Uli just mentioned, SBI has a significant policy advocacy role in the market. So the question that we would like to pose to you is that how do you think that Indian banks need to engage with regulators and authorities towards ensuring seamless policy clarity in climate opportunity sectors? So what is your view on this particular topic, issue?
Yeah, Neha, thank you for the question. See, when you look at climate change and climate risk and how to address it, without saying it's a global problem.
Mm-hmm.
And it needs global solutions in a very coordinated way. Every stakeholder has a role to play, whether it's a policymakers, whether it's a regulator, whether it's international bodies, financial institutions, everyone has a role to play, and it's complementary. Each stakeholder has to complement the efforts of others and facilitate. So in that way, see climate risk being a relatively new focus in India. I say relatively new because all of us have been working on it, taking steps to address that problem, maybe not in so much a focused way, but the focused attention as there is today, it has come recently. So engaging with policymakers, you asked about regulators, I'm adding policymakers also to that, because enabling policies, facilitating policies is a prerequisite for banks to actually go full throng into this sector and take care of the requirements for funding in the newly evolving areas. So we do engage with the regulators, we do engage with the ministries involved, formally, informally. There are parliamentary committees on energy, Ministry of Environment, Forest, MNRE. There are so many engagements with these policymakers, regulators, wherein we get to really advise them, or what is the information which we receive from the industry, the marketplace. Say, if I can give you an example, say, Government of India, there is a scheme called PM Kusum, which is for solar pumps. There are 3 variants, but 2 variants which are to individuals. Not much progress has actually happened. So we were looking at why is it even State Bank of India, when we look at our portfolio, the progress we have made in that particular scheme is hardly anything. So when we look at it, we get to know that these are the drawbacks why people are not really looking at seriously. One is that, okay, there is huge subsidies in this scheme. And after the subsidy, the loan amount is very, very small. So people are not, for a 50,000 or 40,000, people really do not want to go to the bank and take a loan. Second is that the class of people on for whom this PM Kusum is more relevant, they get either free electricity or heavily subsidized electricity. So why should I be installing a solar pump? So these are the kind of feedback we get from our portfolio holders, our borrowers, which actually helps the policymakers to teach the terms of a scheme or put in policy enabling policies. Likewise for solar. Say solar, one important issue what we tell them is that say net metering. Say the surplus electricity which we sell certain states, one issue is that, okay, discoms, certain states, they are very, very cooperative in facilitating that linking to the grid, etc. Certain states, not so much. Then the net metering issues. So these are the issues which we get to garner from the market information that we are able to pass on to the policymakers, and even in the regulatory space also, we are able to engage with them formally, informally, which helps in better facilitating policies, regulations. Ultimately, it helps everyone in addressing the problem.
Thank you, JC. I think that was a very relevant point, and I will give it to Sarojit. I was holding forth in your absence, Sarojit. But I think one of the questions to be sort of probably addressed as we go forward in the discussion is not only the engagement that we require from between financial sector entities, regulated entities, and policymakers and regulators, so that the system of regulations is actually adopted well, and those challenges are addressed right from the day go, but also how the banks and borrowers actually engage with each other when they are making their transition plan, both from the decarbonization point of view as well as from the resilience point of view. So I think if you would address this question, say, going forward, that would be very good, but over to you.
That's first of all, thanks, Neha, for holding the fort. I had a bit of tech issue. Yeah, that point you said, it's quite it's all the more relevant because it's such a heterogeneous ecosystem, right? The borrower community, and it's so difficult from the bank's perspective to put a templatized approach. And maybe we'll take inputs from our bankers, all of them who are actually working on this space on how they would be addressing this. Manish, let me go to you now regarding measuring, scoring, rating loan project for potential climate risks. What do you think would be some of the challenges that your credit officers may face if they really want to integrate a climate risk score within the broader credit rating score, rather than just keep it as a standalone score? Is there a way to address this through capacity building? And do also, when you are saying, do also bring in that borrower aspect, that does it really depend on particular type of borrowers where it may work, and certain type of borrowers where it may be more difficult to make it work? Over to you.
Yeah. Uh, Quite a heavy question, I would say. So very clearly, yes, capacity building is the need of the hour. Understanding, even for the risk officers, a clear understanding of physical risk, transition risk, the difference between the two, what are the parameters that need to be assessed. See, I was recently reading, the India CEO of Coca-Cola said, India is a vast country. It should be treated like a continent by itself, not a country. So there are these disparities, being such a vast country. So what is relevant for a particular sector in a particular region or a geography, that itself poses a challenge. So therefore, the credit officers, even if we do a capacity building, ultimately it has to be a sectoral approach that needs to be adopted by the bank. It needs to be a borrower approach, and there it can be a differential approach, large corporates versus SMEs versus MSMEs, because each of them would have their own challenges, especially the MSMEs and SMEs. So how that can be facilitated, one of the ways, as JC mentioned, is by hand holding some of the borrowers seeking information. But selection of the appropriate metrics, that is a challenge for the officers. If that is a challenge, then integration of ESG risks into the mainstream credit evaluation automatically becomes a challenge. So I think the starting point, again, while there are challenges, I'm also trying to bring in some of the solutions, because we can't be discussing only challenges. So I think one of the things that the large institutions can do, and this is irrespective of the sector, whether it's the real sector players, or whether it is the financial sector, I think more and more, when we go out to recruit people, we have to work along with the large institutes like the IITs, IIMs here. Can they really build courses? The capacity building has to start right from there. You would have read, there is a large private sector bank which is working with IIT. They're setting up centers of excellence. There is also some initiative being taken, I think, by one of the large corporates like Mahindra Group. They are talking about a sustainable university. That is how I think it should start. Doing capacity building on the job may really not yield to a long term solution. People have to start thinking about it right at their academy, at their graduation level. So that is one. Number two, the challenge that we are facing is, say, everybody is reading that the PCAF framework for financial institutions, the global GHG accounting and reporting standard, which is embedded in the PCAF framework, that is the way to assess financed emissions. Now there are those data requirements. They are around those 6 categories. However, for a country like India, there are certain areas which are not getting addressed. Now, India as a country, we are dependent 15% as GDP, we are dependent on agriculture. Under the PCAF framework, there is no approach on how we can measure lending to the agriculture sector. For example, lending for consumption, which is basically personal loans. Now, that is the next challenge. So, unless these things are first addressed, I think embedding ESG into mainstream credit rating uh, cannot be addressed.
So that will be really a factor of some of these things.
Exactly. Exactly. And then, coming to the second question with regard to the borrowers, hand holding, of the borrower seeking information. Now, the questions that we need to ask the borrowers also have to be relevant from a sectoral perspective.
For them, yeah.
I can't be asking a cement industry question to a steel sector company. So that also, is a, I would say, training and capacity building that we need to do at ground level. So that, and therefore that engagement with the borrowers is important. It actually helps build that understanding at both ends. It helps the companies to understand what are the bank requiring, and it also helps the bank to understand how a particular company operates in that particular sector, or what could be the challenges in that sector. For example, what is the decarbonization pathway for a large steel company in the steel sector. Now, that is how I think that sharing of information will happen, and then that will trickle down to SMEs and MSMEs. So ultimately, in any case, we have to address the value chain as well.
Maybe a larger role for the industry bodies or industry associations or the nodal agencies for sectors may also be required. That's also probably going to emerge a very important stakeholder in coming time, because they are the sector specialists and they have the they have the front face with all the industry players of that particular sector, and maybe that is that stakeholder gap that probably needs a bit of bridging the gap as.
So you're right, Shurajit. In fact, these kind of associations can play an important role in becoming a central repository for information. I'm taking an example of Singapore. In Singapore, they have actually created these groups which enable, storing information, gathering information, and making it available. It is like the credit union, or the credit scores, which are available for individuals. It is, through a particular agency. That kind of a thing will have to be developed.
Got it. Thanks, Manish. Ajit, let me move to you. One question at this point, especially from rating, measuring climate risk is concerned. I want to raise the question of size, the size of the bank. So your bank, for instance, as a mid-sized bank, your portfolio would be as diverse as State Bank or ICICI, but it would still be a smaller size in terms of magnitude. Do you see that size as a natural advantage towards actually facilitating practical implementation of climate risk measurement? Or do you think that size actually eventually does not really make a difference? And the reason I'm asking is that, large-scale capacity building programs in climate risk management, do you think they should start with the mid-sized banks first, try to align with their practices, take the learnings, and then look at the large giants in the financial space, or the other way around, or it doesn't really matter? So wanted to get a bit of view on the size. Does size matter here?
The size matters. Actually, it really depends, and I'll divide it into three parts. So the first and main, most important thing is capacity building, as we have been already discussing. So actually, in the case of capacity building, being a mid-sized bank, actually there is some level of advantage in implementing the system and processes internally very much faster, because the percolation is needed only to that level, and we have a very good state of art architecture in that case. We are having online sessions, offline sessions, and we are doing it thoroughly, and we are able to. And if you see, the last 3 years have been a learning curve for us. Each of us were doing more things in this area, and we have already implemented the ESMS policy. So even when we come to climate or all these policies, the level of comprehension that we are having or our teams are having from a day to day is actually getting changed. The way we understand things and the way we are able to give it to others also changing. So we are having continuous sessions with them, and this in turn is helping the team as a whole. The sessions are even planned such as it is starting from the business RMs, like whether it is a business relationship managers, then the credit, then the monitoring, because the policy or the cycle as such starts from the person who is meeting the customer first, and he needs to first of all educate the customer, then only all the things happen seamlessly. So that is one thing. And as Manish pointed out, sectoral things. So we cannot ask the same question to every sector. So there also we are coming up with sectoral studies. Every month we are coming with the study on each sector. Until now we have done around 12 sectors, sectoral study on 12 industry sectors, and also framing questions which should be asked when we do any site visits to each of these sectors. So that is in the process. So so the first question, like it is advantageous being a mid-sized player in the capacity building. The next one is practical implementation. So we have all these things, we know all these things, but when we approach the customer, being a mid-sized bank, our leverage will be less, because our portion of advance will be very less. And when other banks are not asking, why should I? So all these things are coming as a challenge, being a mid-sized bank, and we may not be the largest lender in many of the transactions, and the challenge is there. And being a larger lender in the market, they can bring the change more in that manner, whether with SBI or like larger banks will be able to will be having that advantage in that manner, because while everyone agrees that climate risk is real, the approaches to many to manage the same is still in the early stages of evolution, as you all know. And unless something is mandated by the regulator, each bank will be approaching it differently. And the customers need to agree to all the requirements of the lenders. In this case, actually, we already know RBI has several discussions. They have come up with the discussion paper, and we are awaiting for the guidance and the framework from RBI, so that there will be a level playing field. So that is a thing. And third most thing is the data. And the challenge of data is size agnostic. It is everywhere. Though we might be having diverse customers, actually the data, if you see, if you want to actually study or have implication, or to see what finally implies or converts into risk, we need to have a lot of data. And I think in the Indian context, we have to travel a lot more in this area. And that is where, again, we need to get something from the regulator, as well as all you are helping us, all the consultancies will be must be having a major role there, who can help the banks in all these areas. So that way we can group into three.
So one of the points that you said where the customer interface, that there are challenges because customers obviously resist, and that is a very natural thing. It goes back to what the point Neha said, that how do we manage that equation? And in fact, maybe in the subsequent answers, if you, Manish, Ms. JC, could also weave in that within the heterogeneous customer ecosystem, is there a particular type of profile of customer, certain maybe, some profile of a particular corporate borrower who is more amenable or open to these things rather than the others, because that's really the low-hanging fruit to start off with. If we can convert that low-hanging fruit, it makes the job easier to use those as case studies to convert further borrowers in the low carbon transition journey. So that's just a point to I'd like all of you to keep in mind in your subsequent responses as well. Or if you want to add something quickly here.
No, just to add, from my experience over the last 3 years, where the way we are dealing with customers, it has changed a lot from where we started into 21 or 20, because none of the customers are also understanding the challenges. They are also like, I have done personally many of the site visits wherein, like, when the RM speaks to a customer, basically they are speaking to the CFO. But when we are doing the site visit, we are going to the site and we can see what all things they are doing in the E&S area. Yeah, each and every point they are able to discuss with us. And the point now, what we are having is, like, the E&S team is often having calls along with the E&S officers of those companies. And when we do the visits also, they are able to explain all these things, and even they are having arrangements with a lot of consultancies, because they are also in this journey, because finally they have to sustain. So the customers who know that are already doing all these things, and it is the thing, like, if you see the listed companies, they're all having the data and they are doing all these things. It is coming to the lower side only. We need to again percolate to them and make that more understanding finally. Otherwise, it will be finally converting into the transition risk in the coming years.
Sure, thanks. Let me now move to the last round of questions. This is, let's talk a bit more about the climate opportunities piece. So Ulrich, a lot of regulations, policies are evolving as we speak in the broader markets. But at the same time, it's creating a tendency in the industry to wait and watch for better policy clarity. Manish did mention a very important point, that how do we actually push the regulations, but the fact remains a lot of players are still waiting for regulations in many markets globally. You would have seen that in your research. So how do you see other markets actually navigating this challenge? Are they continuing to wait, or are they jumping in to capture, at least the initial market share? Because the initial market share from a business perspective is the most important. So how do you see this happening, playing out in other markets?
Yeah, I think that's an important point. Of course, there is a tendency across the industry to wait for, government supervisors and so on to provide guidance. But I mean, at the end of the day, this is really a strategic issue for each and every corporation, right? I mean, so at a fundamental level, we know the direction we need to travel, right? We need to move towards a low carbon net zero economy. And of course, in an Indian context, that journey will take a bit longer than, say, in European countries. But the direction of travel as such is pretty clear. And also, very importantly, if we look at, changes in technologies, for example, I mean, irrespective of the fact that coal is the dirtiest of all energy sources, there are also now cheaper sources of energy. So kind of the industry trends, the technological trends, and so on are pretty clear, and we fundamentally know what we need to do, right? We need to move away from fossils to cleaner energy sources. So, of course, it's important and helpful to get guidance from governments, from supervisors, but I think delaying action at the level of the financial institution because we don't have guidance, I think this is a cheap excuse. Of course, when it comes to the intricacies of, say, climate stress testing, of course, there you do want to get as much guidance and so on. But at the same time, we all know, we all understand now that climate risk, transition risk, I mean, of course, also physical, is a material risk. So we do need to understand that. So all the things we've discussed today about, building capacities, in-house capacities for better risk analysis and all that. I mean, this is something that needs to happen, that each and every financial institution can take forward, irrespective of the speed or not of its supervisor. And so in that sense, I think we also need to see the responsibility of each and every financial institution. And talking about opportunities, I mean, indeed, this is the role of strategic management to identify these opportunities. And I think by now, there should be a pretty good understanding that there are a lot of opportunities in the green economy. Of course, corporations, financial institutions need to decide to what extent they still want to continue financing kind of the old dirty industries. But when it comes to better risk management, kind of ultimately, banks need to reduce their exposure to dirty, high carbon industries and really support the transition to low carbon. And so in that sense, I think any cause for more guidance and we can't do anything now because we don't know. As I said, I think that's a cheap excuse. And I think we need more leadership from financial institutions. There's certainly at the global level, kind of with the world's largest financial institutions, they all talk a lot about net zero and so on, but we don't see that in their actions. We still have trillions of dollars flowing into all kinds of high carbon sectors, new fossil fuel exploration and so on, which is very much not in line with any net zero pathway. And so I think that, we need to call on our financial sector leaders to really be part of the solution and develop these new business areas, support industries to adjust, which will make all of us better off in the end, rather than cling on to some old businesses, which may indeed pose a significant risk also to the balance sheet of the institution, but also the financial system and the economy at large.
Thank you, Ulrich. Ms. JC, moving to you, climate opportunity, climate risk are really the two sides of the same coin. A lot of banks globally are also trying to look at, targeting a few carbon intensive sectors or geographies within their portfolio map, as far as, opportunity targeting or risk measurement is concerned. Would you recommend a similar approach towards all this, even in India, basis, what you basis your experience? Do you think that may be the ideal way? And if so, then what is the sort of capacity addition that you really would want to see within the Indian banks to that extent? Over to you.
Actually, we did an exercise. Manish was also referring to that. Why not we look at it? Why should we be really waiting for a regulatory push. Why don't we do it on our own? Actually, we did a pilot study. We engaged a climate tech startup to measure the financed emissions of our domestic portfolio. And the results, no surprises there. Results was that nearly 27% of our exposure, which is to industry. State Bank has a asset book of roughly 30 trillion rupees, out of which roughly 8 trillion is to this, say, 9 or 10, those red, so-called red sectors. So the our exposure to these 9 or 10 sectors, highly polluting sectors, it is 27%. And the contribution of this particular portfolio to our portfolio emission is more than 80%. So no surprises there. More important, 3 sectors, that is hydrocarbon, power, and iron and steel. Our exposure out of this 8 trillion to these 10 sectors, our exposure to these 3 sectors, it's 6 trillion. That is more than 20% of our portfolio. And so these 3 sectors, if we focus on, it will be like we'll be taking care of more than 60% of our financed emission. So it makes sense when you look at it theoretically, yes, it makes sense to adopt a targeted approach. Look at those sectors which are most polluting, focus your energies, efforts there so that the results are maximum. But again, say I said hydrocarbon, power, and iron and steel. So as a State Bank of India, whether we can take a call that, see, from tomorrow onwards, I'm not supporting power sector. We just cannot take the decision because we will align ourselves with the national priorities. We being an energy deficient country, wherein the government is going ahead, the Power Minister made a very categorical statement that yes, we are going ahead with coal power thermal power plants. So if the government is going ahead with that, as a State Bank of India, maybe I wouldn't have the flexibility to say or take a decision that no, I'm not supporting that. Otherwise, theoretically, if you look at it, 20% of my portfolio contributes to 60% of my emission, it looks good. So that is why initially I said our NDC, India's NDC goals net zero 2070, we're actually eagerly awaiting the pathways the government will chart out to reach that net zero by 2070, so that we can align our climate strategies, business strategies with the government policies, and we can actually balance climate concerns as well as economic concerns. So this is one exercise we did. And again, coming back to the same question, we also are in the process. So we came out with an RFP for measuring our whatever study I said, that was a pilot study we did, but we wanted to do a more comprehensive exercise. So we came out with an RFP maybe 2 months back, but the kind of questions queries we receive from the players in the field, including the very established, say, big fours, etc., from the field, it made us realize that what we are looking at, the complexities are much more than we actually realized. So they wanted, one major ask from them was that technical collaboration be allowed. It made me, like earlier point, that the capacity building or availability of expertise talent pools within many organizations, they're yet to build up. So that's why many of the very established consulting firms requested that please allow technical collaboration. So we are coming out with that RFP again, wherein in all probability, we will be allowing technical collaboration. One will be for measuring financed emissions, based on which we will identify sectors wherein we can focus for the migration or transition to low carbon processes or technologies. The second will be, again, the other side of the coin, measuring physical risk, transition risk. Once that is done, we will be integrating integrating climate risk as a part of our risk assessment models. Those are the 2 things we are working on. And again, if you ask how much capacity, how many people, how big a team, as of now, honestly, I do not have an answer. But only one statement I would like to make. we had an interaction with a European bank which has actually gone far ahead in this space, and their team size, it's more than 200 people with a sub team which looks at biodiversity. So that way, my only sense is that the requirement, team size, or capacity, it is going to be huge. But if you ask me for a number on ballpark, I don't have it right now.
Thank you. No, those are very practical points because every market has its own particular nuances and compulsions. And in fact, let me just make a rephrase that the decoupling between economic growth and emissions growth is really about managing the coupling between economic development and emissions at the end of the day. So that's really the journey, if I put it in another perspective. Manish, let me take that cue from what Ms. JC said about national development priorities. Business decisions at the end of the day will be guided by the country's national development priorities of the day. How do you think banks can really combine this within their risk adjusted return objectives? Because that's really what it boils down to, the numbers game at the end of the day for a bank. And towards this, what do you think can be the nature of support they may require from international institutions or even domestic institutions for that matter? Your views on this. Over to you.
Yeah. See, I think we should look at it from two perspectives. When we talk about the banking sector supporting economic growth, aligning ourselves to NDCs, we should always bear in mind that now, of course, I'm talking about a journey which the banking sector in India has undertaken over the last decade, is about taking a risk calibrated approach to business. Return of capital rather than return on capital has become paramount. Keeping these two things in mind, what the first thing probably where the banks can review their business strategies is protecting the current assets, infrastructure assets which we have financed. There, that is a big opportunity in itself. Over the last 10 years, the kind of infra development that we have gone through, now those assets which are available as collateral to the banks, they themselves are right now vulnerable to natural disasters or changes or other risks emanating from changes in climate. Isn't that a business opportunity in itself? We have to protect those assets. Whatever needs to be done in terms of additional financing, in terms of improving or relocating, in terms of strengthening, etc., that itself will need financing. So that is one perspective of how we can align business strategy with a risk return objective. It's a risk that is already hitting us. Number two is the transition financing. So even if we are looking at dirty sectors, ultimately we have to transition them out. We have to ensure that it's a just transition, what is popularly called in this particular space. So there will be financing which will go even to the dirty sectors. But the way it has to be done is how can we really ensure that it is going really uh, for going on the right path and moving away from continuing the dirty business. So these are the two areas which I feel can align in all ways. Business strategy aligns to risk objectives, risk return objectives, and it aligns to the NDCs. That is how I would like to look at it. Number two,
Fair
the
point.
ask.
Yeah.
Yeah, your second part of the question, the ask for, I would say for commercial banks. The big challenge that currently, we are facing is asset liability mismatch. We know that there are some of these areas which are still under R&D phase. A lot of pilots are happening. They have not yet fructified as commercial operations. Now that is the risk which now commercial banks are very hesitant to take. That is where probably more equity is required. We didn't talk about it, but there is literature available saying that for India to achieve net zero by 2070, 10.1 trillion US dollars worth of financing is required. Now if you look at it from a lender's perspective, there is always an equity portion in any kind of a lending. So even if I take a 25% equity portion in that, where is that going to come from? that has to come from private finance. That is where, probably funds need to step in. The international funding community has to step in if they really feel that India is a growth market. So that is one area again where, some kind of support is required. The second kind of support is required is through multilateral agencies, through MDBs, through development financial institutions. They have to step in and fund some part of that entire financing part. They can take the piece. Obviously they will get a return on that higher risk that they might be taking, but they have to step in. They will have to come as a first loss default guarantee mechanism, and that is where the government policy will play a key role. How is the government supporting that? So that is the other area where probably support can come in from international and domestic institutions.
Okay. In fact, it also boils down to the fact that, you mentioned about disclosures earlier, because disclosure by itself means nothing. It's how do you use the disclosure in the business strategy, and that's how then the entire connection would happen. Ajit, let me ask you the last question of this session. The same question really that I asked Manish, but from a mid-sized bank perspective. What is the nature of support you think mid-sized banks particularly may, require from institutional, institutions globally, whether it is, the MDBs or even other.
Am I audible?
Yes, you are.
Hello.
Yes.
Yeah. So actually, coming to this, I'll take it in two aspects. So we have committed to have a green finance portfolio of 130 billion by 2025. So there, what we done is we have adopted the IFC's process, wherein we are categorizing the green loans. So where is the challenge? Because at that point of time, there was no even now there's no formal taxonomy in India where. So we have chosen that definition that is used by IFC to classify the climate loans. Now this could differ from the taxonomies and domestically and internationally. Hence, there could be a result. This could result in a transaction being classified as green by one and not green by others. So there's a confusion there. So that the international bodies and institutions actually should work with government and regulatory bodies in finalizing a taxonomy for India, which can be used by all the parties, such as banks, industries as a whole. So this is one aspect. And where we need the help, the other aspect is how do we underwrite these newer technologies? Most of the climate-related finance that is coming is long-term and relatively emerging technologies, which banks may find hard to assess the inherent risk or to comprehend and implement the climate risk there. Suppose, take the example of solar. The major green finance that banks are doing is in solar. When we come to solar, actually, when we consider the environmental and social or the climate risk, actually solar comes under the high risk. Even it has the biodiversity issues. You might be knowing all the things that is happening in Rajasthan regarding the Great Indian Bustard, which is getting extinct as a bird, which is around 100 only number. So all these are triggering the thing. So, and even there's a Supreme Court order which says all the power transmission lines should be made underground to save that. But if that needs to be implemented, then everything would be unviable. And now it is again in the court. So these are the things which needs to be understood. And even other new technologies which might replace all these things, if banks are not able to comprehend all these things and adopt the climate risk appropriately, again, all these will be having trouble in the risk area. And as Manish pointed out, the next point is regarding because all these are project loans, which has a period of might be 10, 15, and 20 years. And we need to see, this is again posing risk on concentration as well as ALM, asset liability management related challenges in the banks. So actually, as banks, we need to work together to find some common solutions that meet individual objectives and national developmental priorities. And here, actually, the sharing of knowledge and learning between the banks can improve the process system as a whole. And institutions like IBA, IABF, and all of you can help us where we can create some common platforms for sharing these learnings, so that while all these practical implications will be addressed through these manners. So that is where banks need the help. Basically, comprehending and learning, like the aspects that needs to be addressed while implementing this climate related risk.
Thank you, Ajit. Let me quickly hand it to Neha to check with the audience questions.
You're on mute.
Yes, I will quickly go to the questions. We have received about 13, 14 very interesting questions. We will not have the time to tackle all. So I will try to at least ask 2 or 3. The first one is very interesting, and any one of you or each one of you could do a rapid fire answer, a minute each. How banks are nudging its customers, how banks are nudging their customers to also share a transition plan to low carbon pathways. And how are they supporting their customers, especially in the hard to abate sectors, to develop a transition plan and share with the banks? So is there anything that is already a part of your thought process right now? Because one thing I can share with you, that we also engage with corporate clients who are your borrowers. And when they say that they are producing reports and they are putting certain plans in order, but from their banking partners, there isn't yet a clear guidance on what they want. Anyone?
I can take this question, Neha. I can take that question. So, in State Bank of India, what we have done is that we have developed an ESG framework wherein we rate our large value customers. Listed companies above 100 crore and others above 500 crore. Of course, large value customers. We have developed a framework wherein we assign, based on various parameters, we assign an ESG rating to each of these companies. So that is the first step we took. So the next step will be, ideally, whether there could be a threshold below which we may take a decision that, okay, we should not be onboarding this particular project or customer. Another way to look at it, again, I'm just thinking aloud, it's not that it's a policy within the bank. Maybe like a logical step could be that whether the pricing charge could be linked to the ESG rating of a customer. So once we implement any of this, where there is a commercial implication to the customer based on his ESG rating, that is our ESG framework. I'm not talking about ESG rating by external entities which do that. That is the time when we can start engaging with the corporate clients that, okay, this is a way, like your pricing, it is such and such now. If you take care of this, if you have a transition path, that itself gives you a score. That itself helps you improving your score, which actually will help you reducing your pricing. So that way we can start engaging with the clients, nudging them to put in place a transition policy for them for reducing carbon, for migrating to better processes, technologies, and that transition capex, as Manish and a few other panelists mentioned it, that transition to bring down emissions, that we can fund. That is the opportunity in climate that is there for the banks. So we are working on it, but we just started working on it. We will be taking it forward. We will be engaging with our corporate clients in these specific sectors which actually contribute heavily to carbon emission. And we are hopeful that yes, we taking such an initiative should actually result in many positive developments for the corporates to really look at their emissions, their processes, and improve their operations. Thank you.
Thank you. And I think given that your State Bank of India, things that you do will actually be market making and quite important. So the other one is a related question, which is that what role can Indian banks and FIs play to support and mainstream just transition planning? What kind of regulatory interventions from a financial sector point of view would be required to address transition risks in specific sectors which are undergoing rapid transformation? For example, coal to RE, from ICE engines to EVs. So this is a question that maybe anybody else could answer, Manish or Ajit.
Yeah, should I take it up, Ajit?
Yes, please.
Okay, Manish. Yeah, okay. Yes.
Yeah, sure. So I think we had spoken about it, especially the banks of systemic importance, SBI, ICICI, HDFC. We are
Yes.
working with various ministries and, in enabling that. So ensuring that policies are put in place. See, the government has already a Panchamrit target. They have enabled a lot of things through various initiatives, within the union budget. They have allocated certain allocation for the green initiatives. We expect that to only grow year on year. They have raised sovereign green bonds. So there is a clear intention of the government. Now that has to be supported through policy initiatives, and that is where we step in, uh, enable that policy framework. So, for example, we are engaging with the Ministry of Natural Resources and Renewable Energy to put adequate frameworks for enabling that just transition. At the moment, I think I can say this.
Well, thanks a lot. And I think there are many other questions. One question was also something that Ajit, you had spoken about for the need for taxonomies and what is the banking sector doing to advance this within the banking sector and for banking sector. And I think that is a very it's a question which is which keeps on coming up again and again. And we address this, and hopefully there will be some answers provided to us by the policymakers in this direction. So we are running up on time. We have only this much of time to take the questions from discussants, but please be rest assured we will be looking at these questions. We'll also be sharing this with the panelists. Now, Sarojit, if you're good with our conclusion of the panel discussion, could I invite Ms. Sally Taylor, who is the Minister Counselor at the British High Commission in India and looking at climate policies.
Thank you very much, Neha, and thanks very much for the chance to just say a few words at the end of this workshop. I'm sorry I missed the beginning of it, but it's been really interesting to listen to the discussion of the panel and the different issues that have come up. I do want to say thanks very much to Climate Bonds Initiative, to Octus ESG and ODI for arranging this. And it's something that we're supporting under our partnership with India to accelerate climate transitions. So we all know that climate poses a systemic challenge, and it will change all of our lives. And there's a need for that sort of whole scale changes to respond. We have all the leaders meeting in Davos at the moment, and the World Economic Forum identifies climate risks, nature risks as among sort of the top risks we're all facing. And we all feel that. I've heard some of the speakers highlight these different risks that we're all grappling with. And I think it's something that, we feel, in the UK and I think India, we very much both recognise this and are looking to sort of be ambitious, to provide some leadership in sort of different and joint complementary ways across a whole range of activities. And we were talking about climate last week at a forum with the Indian G20 Sherpa, Mr. Amitabh Kant, who was talking about India's ambition and challenge really to both develop and achieve the SDG, the Sustainable Development Goals, without the same reliance that other sort of developed countries have had on fossil fuels, and how that will be a sort of first, and how important that is for India. But of course, it's also important for the world and as a model for other countries that will come. So it's a really important part of the work that we do here. Very pleased to work with India across a whole range of different things, be that research and technology, be that sort of policy spending choices we're grappling with, be that investment, including into the private sector. and also international activities. And finance is a really big part of all of that. And we have a partnership across a range of things. Our finance ministers meet, and this is all part of the economic and financial dialogue they have. We have had the G20, where India's very much prioritised it, including with the MDBs and the multilateral development banks. And that's something I think we very much share as a common agenda, and something which the UK has always been very interested in. I think India's provided some great leadership around that. And of course, there's partnerships between institutions. I know the City of London are working with Vicky on sustainable finance. And more recently, we've had at COP the UAE leaders' declaration on the global financial framework, which sort of sets out all the different multiple sources of finance that's going to be required, the scale of the challenge. So clearly, the financial sector is very central to all that. It's an area where the UK has very strong interests and strengths. The City of London, I think, has issued more green bonds than anywhere else. And how it all moves forward, I think, is important for us, and it's also important for India. And there is, lots of things that have happened already, but I think we recognise that there's still quite a lot to do if we're going to really transform the way in which the financial sector operates. And so, it is really, I think, we sort of see the need to just really work out how that happens in practice. We kind of know what we're aiming at, but it's the sort of the detail. It's how to think about what does it mean in business operations and decisions, what does it mean for policy, what does it mean for the regulatory framework, the risks, and also the capacity and skills. And of course, this workshop is part of a sort of second phase of work we've been doing around capacity building. So it's been really great to have the experts from the sector to sort of share perspectives, to talk about the sort of the detail of the challenges we're all grappling with, to sort of give the examples, the ideas of how we move forward. And so, really want to thank everybody for that. I think it's always sort of refreshing to hear that sort of experience, that sort of the detail of the practicalities, but also the ideas. What is it that's needed? And I do think there is a lot of value in government, the industry, business, sort of being able to talk together and to be able to sort of understand and to figure out how it is we're going to make this transformation. So I'd say, for our part, it will very much inform our thinking and next steps. And I hope that's also true for others. So thanks very much.
Thank you, Sally, a lot. I think that was very good again, in the spirit that Ms. Joshi actually outlined in the beginning. Before I close with a vote of thanks, maybe I would take the liberty to actually go back to Geetu and ask her, or actually just share with her that you saw today that there is a lot of initiatives that are starting to happen. They need to be embedded further in the DNA of companies as well as financial institutions. But also the regulators and policymakers are within the ambit of both learning and providing the best that they can to the ecosystem. So from this discussion, are there any closing thoughts that you would have, Geetu?
Thank you, Neha, and it was wonderful joining the webinar today. I did hear all the experts on the topic, and it was, a very insightful discussion. And it's, as you said, it's good to know that, there's so much happening, but yes, there's still so much work which needs to be done. And of course, as the experts did mention that capacities, building capacities is one of the key objectives and something which we really need to focus on in the coming time, so that we can actually scale up sustainable finance and achieve the objectives which, we envision, whether it's G20 or COP, in terms of increased finances and aligning financial flows to climate goals. So, that was useful, and it's also good to see that so much is also, happening in the banks, and there's awareness, there's need for building more awareness, as Manish ji said, that, we could have more institutions, organizations, partnering with them and having more courses on this subject, so that there is more expertise in the field. And of course, data is required, and automation was spoken about, that it's not just data, but there has to be automation there as well. And yes, it was a pleasure being here with all of you and listening to you all, and we'll continue interactions. Thank you so much.
Thank you, Geetu. And before I say, or everybody says bye to each other, it is something that I have to also say as part of my vote of thanks, just to remind everyone, and as everybody has spoken, that we need more collaboration, we need more cooperation, we need more institutions to come together and build that narrative and consensus that is required to amp up both the action as well as the required policy measures that are important for the financial sector. And India Initiative on Climate Risk and Sustainable Finance, the overarching purpose is actually to support regulators and policymakers, but not only stop at that, to build capacities of the real economy entities, of corporates, of borrowers, as well as of financial institutions, and to support them with all the tools and expertise that we can bring in from the domestic sources as well as from international expertise, to bring that, adapt to the Indian needs and opportunities that are over here, and ultimately to shift investments towards both low carbon and less risky investments, and towards that, how to manage risk and how to augment financing that is so required and is actually not in the required amount or at the required speed for the transition to take place in an orderly manner. So with that, a big thank you for the organizing team. Thank you to ODI for providing all the support on the IT and the AV front. Thank you, Octus, for being, the moderator of this discussion, but also as a consortium, really working together on the policy side, regulatory side, and actually going really to the, what we call bottom up, going to the banks, going to the corporates to actually bring all of those learnings back into the fold. And this interaction and this exchange will continue, both with the regulators and policymakers, as well as many partners going forward. Thank you so much.
Thank you
for your time. Thank you.
Thank you.
Thank you to all the speakers. Thank you so much.
Thank you.